Lorne Baring, Managing Director of B Capital.
Andrew Summers, Head of Collectives and Fund Research at Investec Wealth and Investment.
Philip Philippides, Head of ETF Sales in the UK for Amundi.
Alex Marshall-Tate, Head of Third-Party Research at City Private Bank EMEA.
Yuri, Editor-in-Chief, Professional Wealth Management.
Delyth Richards, Head of Funds Research, Kleinwort Benson.
Alan Miller, Founding Partner and CIO, SEM Private.
Ashok Shah, Investment Director, London Capital Asset Management.
Pauline Engelberts Global Head Investment Products, Wealth Solutions, ABN AMRO.
Our aim this morning is to get an indication of how ETFs are currently used in private client portfolios, what the future holds for this type of investment vehicle, and how their proliferation will not only affect private banking business models but also shape the entire wealth management landscape. I remember when some of the Swiss banks, UBS in particular, made a very strong point before the global financial crisis of putting ETFs at the centre of their construction of discretionary portfolios. Was there a particular eureka moment when you thought, here is a marginal, worthy but dull instrument, but maybe this could just prove to be a key part of the future fabric of wealth management?
I'm not sure if there was a eureka moment as such, but we did start realizing that there was an added value in our total portfolio strategies for our clients, and giving a quick access to a market that they usually couldn't get to, and based on that we worked with it further. I think one of the aspects is that it's a lower cost, and now a lot of clients are looking for that lower cost and looking for more transparency, and the time is right for the clients to they're asking more questions than they used to in the past, and this provides more answers to the questions that they have. I think ETFs, you've got a broader playing field because you can use different strategies, and we've noticed that the clients actually like the investment theme. It's recognizable for them. They don't have to know all the technicalities, but they understand the theme. They know what they're following. But it gives you, the ETF gives you more flexibility to play with different strategies than a fund does.
Investec has become one of the largest, most prominent players now in the UK private banking marketplace. How much of a role have ETFs played in the reshaping of this marketplace? Have they fundamentally changed the way that you work?
Not really. I mean, I think it's fair to say that we are generally pretty strong believers in the value of active management, and with a few notable exceptions, with the right team and the right process, you can find active managers in most markets that can outperform. And although there are certain situations where ETFs are very useful, and we definitely use them in certain circumstances, on the whole we find that in most markets, in difficult volatile markets, there is no substitute for human experience and the role of the human being in making investment decisions. So the vast majority of our assets are in active managers, and around the margins that probably won't change much in the foreseeable future.
I'd like to bring in Alan Miller here, because you're formerly the hedge fund legend, now a champion of ETFs as a tool for democratizing financial services. Do you believe what Alan says? Do you have that faith in active managers to create value?
I mean, there's hope and there's facts, isn't there? And the facts are these. Firstly, that if you look at the last 110 years, the average real return on equities is just 5%. So if the whole chain of costs, which for many private wealth managers is 3 or 4%, that doesn't actually leave a lot. The second fact is that to actually judge, this is from Cass Business School, to judge whether a manager is lucky or skillful, you require 22 years of investment performance. 22 years. And the other fact is that consistently, the actual odds, it's a bit like kind of betting in a casino. The longer you're in the casino, the more chance the casino has to win. So what the casino wants is for you to stay in there as long as possible. The same is true of active funds. And again, here's another fact. The actual chance of an active manager beating the index 3 years on the trot is 4%. So everybody says, that doesn't matter, because I am going to select this 4% that does it. Whether everyone's obviously doing it with best intentions, but actually the odds are hugely stacked against the investor. And it's interesting, we were saying before, and particularly in Holland, which are much, much more advanced than the UK in terms of regulation. And they are literally about 2 or 3 years ahead of the UK. And they're putting it already into practice, rules so that people can actually see the total cost. As I say, so in the UK, we have a huge number of private wealth banks where the client thinks they're paying 1%, but they're really paying 3.5% by the time you've added in transaction costs, the underlying fund costs, product wrapper costs, the initial costs, all the other costs, whether fund-to-fund hedge funds, or whatever it is in the whole portfolio. And we're only now 18 months away from the truth being revealed.